What's up, everybody? This is Flugill Trader Jeff, author of the book Trading Part-Time, and in this video lesson, we're going to talk about the 3 steps to profitable stock picking. And stick around to the end because I've got a free document that I created to help you trade more like a professional. Let's get to the video. Now, I know that picking the right stocks might seem like a challenge, but don't worry. There are 3 steps to profitable stock picking. Step number 1, decide on the time frame and the general strategy of the investment. Now, this step is important because it's going to dictate which type of stocks that you buy. So one of the time frames that you can decide to trade is the long-term time frame. A long-term time frame, in my definition, is any trade that lasts 9 months up to whenever. A common way to refer to this might be the buy and hold strategy. So you buy a stock and you hope to hold it for the long term. You're less likely to get in and out. You want to buy something low and sell something high. For example, this is the S&P 500, which is the 500 largest companies in the world. And we're looking at the 1-year chart, or let's even look at the 2-year chart. So if you look at the 2 years, this is the long-term time frame. So you're less likely to get in and out of a trade. So number 1, you need to decide if you are a long-term trader. Number 2 is you need to decide if you are an intermediate term trader. Intermediate term, in my definition, is any trade that lasts between 4 weeks and 9 months. So I'll go out here to 9 months. This is an intermediate term trend. So are you an intermediate term trend trader? If you are, then you need to trade strategies that are appropriate with your time frame. Okay, so these type of positions you might be in, like I said, from 2 months up to 9 months, but you need to decide, are you an intermediate term trader or are you a long-term trader? This is critical for your success. Another time frame is a short-term time frame. Short-term time frame, in my definition, is any trade that lasts between 2 days and 4 weeks. I like to look at this. Okay, so this is a short-term time frame. So are you going to trade based on the short-term trend? If you decide that you're going to be a short-term trader, then you need to trade strategies appropriate with that specific time frame. You might be classified as what's called a momentum trader. Momentum is the direction of trading. So for example, let's go here and let's take off this study set. We're going to hide drawn items. We're going to hide studies. Okay, so what I'm looking here are the candlesticks. Momentum is represented in the candlesticks. You see how these lows are getting up and down? So these lows represent the momentum. So the momentum is up and then the momentum is down. So if you're going to be a short-term trader, you need to decide which strategy you're going to trade based on the momentum of these candlesticks. You could also be what's called a contrarian trader. A contrarian trader is someone who goes against the overall momentum. For example, if the momentum, in this case, is going up, there's a slight pause or pullback. If you're going to trade here, this is contrarian to this uptrend. So if you're going to be a short-term trader, you need to decide if you're going to trade with the momentum or you're going to trade against the momentum. Step number 2, conduct researches that give you a selection of stocks that is consistent to your investment time frame and strategy. There are numerous stock screeners on the web that can help you find stocks according to your need, but the thing that you have to do is find those stocks after the research that meet your investment time frame and the strategies that you're going to trade. For example, I trade the top stocks in the sectors of the S&P 500. This is the S&P 500. So there's sectors that represent the S&P 500, such as the financial sector, technology sector, industrial sector, staples, and so forth. And I have a group of stocks in each one of those sectors that meet my investment strategies and the time frame that I'm going to trade. Some people, for example, might trade all the stocks in the S&P 500. This is the 500 largest companies in the world, and some people might trade stocks in the S&P 500 if that meets their investment time frame and strategy. Some people might trade the top stocks in the NASDAQ 100, the 100 stocks, or the Dow Jones 30, or even the Russell 2000. Okay, there's no right or wrong answer, but what you need to do is you need to conduct your own research and trade the stocks that meet your investment time frame and the strategies that you decided you're going to trade. That is critical. Step number 3. Once you have a list of stocks to buy, you need to diversify them in a way that gives you the greatest reward to risk ratio. Now that you have a list of stocks to buy, you need to diversify them in the ways that give you the best reward to risk ratio. So if you're going to be trading the long-term trend, you need to diversify your portfolio in those stocks that will give you the best reward to risk ratio. If you're going to trade the intermediate term trend, again, you need to diversify your portfolio, take that watch list of stocks that you created and diversify them in a way that gives you the best reward to risk ratio for the intermediate term time frame. And so I talk about this in my book. We want to make sure that our reward is at least 2 to 3 times the amount of money that we're willing to risk on any one given trade. So if I'm trading the intermediate time frame and I'm risking $5 a share, I need to make sure that my reward is at least $10 to $15. Now, if I'm trading a short-term time frame, for example, let's pull up one of my favorite strategies, which is the bull flag strategy right here. And so if I take this Fibonacci and I go down to here, okay, this is the 200. I've already circled my reward. Okay, so now in this particular trade, I'm going to draw this as support. Support is any area that the stock went down to and bounced up. I talk about this in my book. I talk about this in several videos. We're going to draw a support line right here. Okay, so I'm going to eyeball this, but my stop, which means that's the place that I am wrong. That's where I chose to get stopped out. Let's make this red so you can see it. So, in a short term, I need to make sure that the stocks that I'm trading and the patterns that I'm trading give me the greatest reward to risk ratio. So if I'm trading this short-term pattern and my stop is here, this distance, and my target is up here, this distance, then my reward far exceeds the risk in a trade. So what I need to make sure, and what you guys need to make sure, is that the stocks that you have decided to trade, diversify them into the time frames that you're willing to trade, and then make sure that you trade the setups and the strategies that give you the greatest reward to risk ratio. Once you do that, that is critical to your success. So once you have a list of stocks that you're going to trade, you need to diversify those stocks into the time frames that you're willing to trade. And then when you're trading the strategies that you've decided on, you need to make sure that your reward far exceeds your risk. That's a critical step when it comes to picking profitable stocks. Now you know the 3 steps to profitable stock picking. But do you know the most common trading errors? No problem. I've created a free document that I want to give you called the 10 Common Trading Errors. Right? How to avoid the traps that most people face. For example, trading too much. That's one of the big traps, okay? So I want to give this to you for free. So click the link in the description box below to download it now. If you like this video, then hit the like button below, share it with your friends, and subscribe to the channel. Until next time, this is Flugill Trader Jeff, author of the book Trading Part-Time, and I'll see you on the next video lesson.